Welcome back to the Teaching Tax Flow podcast, everybody, episode 186. We are actually going to be discussing a topic that you probably have not heard talked about here on the Teaching Tax Flow podcast. So as we get into this one here, we are going to dive into the waters of what do you actually have to consider when it comes to taxes in a divorce or even a separation. So again, not the happiest of conversations. However, what we're about to talk about will definitely make you happier in the long run because you're not setting yourself up for maybe some surprises that may hit your bank account. So again, you do not want to hear all this information from me. You want to hear it from my esteemed co-host, Chris Picuro. Welcome back to the show, buddy.
Oh, it's great to be back. This is a topic that's tough. I know, John, I'm in our age, we've had many friends, unfortunately, get divorced or separated. However, there's people that we know. You never know if you should say congratulations or I'm sorry, just one of those things. But we're going to just talk about the tax ramifications. And when you are going through a divorce or separation, John, that's always a big change. But guess what? I have a change for you that's actually positive. I have a surprise for you.
You're not trying to separate from me, are you? You're going to replace me? Oh my goodness,
this, man! My first podcast without a Teaching Tax Flow shirt, but I've got the hat that was nicely sent to me. And John, I think that our accountants are probably not going to like this, but I'm going to say it right now: the first 3 people to put hat in the comments on our YouTube channel after this podcast goes out, we're going to mail you one of these beautiful, pretty expensive trucker hats. So the first 3, just type hat, we'll connect, and we will get your information and send you a complimentary Teaching Tax Flow hat.
Which, by the way, everybody that's watching or listening to this, and that's YouTube, right? So we want it on the YouTube channel.
YouTube.
Look, you have to see this hat to make sure that you like it, for one. I honestly had no clue that he was going to bust this out. And it's kind of funny, Chris. I mean, we both, I have my gray and black one on today and it kind of matches your colors. So, and you're starting to be a marketing guy. See this, you're giving away free stuff. You're swagging it up.
So I didn't even have to do my hair today, but I did it anyway. So it changed in the air, in my first, episode recording, with YouTube. So gosh, we've done over 1.5 years of episodes just on YouTube alone. And we're coming up on, 4 years here, first time reading this. So I got this hat, John, and sometimes these hats are like ugly or they're for marketing, but you wouldn't. And this actually wore to a baseball game yesterday where I went out and watched some friends play. So yeah, man, I'm feeling good. And let's talk about as my appearance. And I don't know if I'm going to bust this out for every episode, but
maybe I'll do my hair.
Talk about divorce.
I'll do my hair. Yeah, I'll do my hair. You wear a hat. We'll completely screw everybody up. But yeah, this topic, right? Like as we started off, so it's not the happiest of things, right? Like it's a change in life circumstances. Like it's a huge thing. And I mean, I personally haven't gone through this, but I mean, I had plenty of separations with crazy exes, but not married to them, thank gosh. But when something like this happens in somebody's life, right? It almost seems natural that not who would care, but they're more concerned about other things that are happening right at that moment in their life, very short term. And, taxes is something they're like, I'll get to it next year. It's nothing I can do about it now. However, I imagine that's probably the case, which, by the way, everybody, we do not script these episodes, so I have no idea what Chris is going to say with this. But, it's things that I'm sure people can plan for to better set themselves up for a, not such a kick in the what when it comes, quote unquote, tax time the following year and beyond, right?
Absolutely. We're going to lay out the 7 most important considerations if you are going through a divorce or a separation from a tax perspective. And from a federal tax perspective, right? Because there are some states that are community property states. There are, you've got a lot of considerations. One thing to consider before we jump into this is that the IRS doesn't know your filing status until you report it. Because marriage certificates are issued by states or counties. And so so a lot of times people think, oh, I have a divorce. It gets reported to the federal government. It doesn't. So it comes down to self-reporting. But let's jump in. The first thing to understand is that your filing status is going to be impacted. And this goes for anyone. Your filing status on the last day of the year is your filing status for the entire year. And that gets, that can be confusing if you get married or divorced. It's like, oh, do I file by myself for half the year? Am I filing with my spouse? So whatever your status is the last day of the year is your status the whole year. So if you were to become divorced on December 15th, you're divorced for tax purposes that entire year. So that's something to understand. Now,
And with you saying
you
that really quick, just to make sure that I kind of explain this too for the dummies like me, right? So you're saying, so say we're in 2026 right now. Say that event, say somebody gets divorced in 2025. So in calendar year 2025, right? When they
Mhm.
go to file their taxes for tax year 2025, even though it's
Correct.
2026, they're filing, doing paperwork, quote unquote. That
Or
event
a lot
happened
of
in
times what happens,
25.
John,
That's a whole year.
someone could uh, have their divorce finalized in February of 2026. We have to look back at what their status was the last day of 2025 to determine their filing status. However, you could be legally married, but for tax purposes, not married. And that might sound funny. Here's how. If you are legally separated at the end of the year and you've lived apart for at least 6 months of that year, you could be considered unmarried for tax purposes, and each spouse could file single, or one might file head of household. The key is they have to match, right? Because if I have someone that's filing married, filing separate, and someone with other person's filing single, the IRS is going to most likely send a letter to them. And we know a lot of times these types of situations can drag on. So if someone says, if a taxpayer says, I'm getting divorced, I'm separated, it's December 31st, the first question is when did you guys become legally separated? And have you been legally separated for at least 6 months of that year? And if so, you may be considered unmarried at the end of the year. Now, is that good, bad, or indifferent tax wise? It just depends. But what we want to do is we want to make sure you are filing with the correct filing status. And we have a lot of content in the Teaching Tax Look um, community, and on this YouTube channel and on this podcast, because a lot of times people focus on the numbers of a tax return. There are so many other things on a tax return that are very, very important to get correct. Filing status, are you dependents, social security numbers, innocent little questions like have you dealt in digital assets this year? Yes or no? Do I allow the IRS to talk, or for lack of a better term, to my tax professional? There's a lot of interesting things, and maybe we'll do an episode one day on all the important things on a tax return that has nothing to do with a number. Could
There
be
you
an
go.
interesting
And
topic.
it's
So,
ironic that you just said that because I seen in an email, actually it was an IRS update email that went out maybe about a month or 2 ago, and it talked about how more than ever, their forms and the process is more detail oriented, AKA more complex than ever because our lives are getting more complex. Like you mentioned,
hey,
digital assets, all this stuff.
like we said, there's no easy tax return. I'm going to start saying easy is a four-letter word
I
because it
like
is.
that.
All right, so
I
if we
like
got to
that.
consider your filing status. Um, And remember, you're not required to file jointly unless I've seen divorce decrees where the spouses consent to file jointly. There's a lot of considerations. Let's look at number two, alimony versus child support. Now, this used to be a big issue before the Tax Cuts and Jobs Act. Before the Tax Cuts and Jobs Act, alimony was a deduction for the person paying it, an income for the person receiving it, where child support was not taxable. There's not a deduction for the person paying it, not income for the person receiving it. Here's what happened, in my humble opinion. There are a lot of people paying alimony. Every person that paid alimony took the deduction they're entitled to. And not many people who picked up alimony reported it as income. So one of the reasons I believe the Tax Cuts and Jobs Act said, look, this matching is crazy. Alimony is not deductible anymore. So if you are a taxpayer and you're either receiving or paying alimony, you have to look back at when that agreement was in place. And if it was pre 2019 or pre Tax Cuts and Jobs Act, you could be paying, you might be able to deduct alimony paid and you'd have to pay tax on the alimony received. So that's something that that used to be a big issue. It's to- you know, again, if a taxpayer says, "Well, I'm receiving alimony," the first thing we have to do is like, when did that agreement come into place? And that'll dictate if it's taxable or not on the federal return.
Perfect.
Um,
And here I am, I'm chuckling a little bit if anybody's watching this, kind of smirking over here. I could imagine what those conversations are like on the IRS's side when they're like, "Oh my gosh, what did we do?" Of course, everybody's claiming it as a deduction, and of course, not everybody's claiming it as income. I mean, just
right.
like there's a
Oh, it
lot
was
of
there's
things that go to that, right? What a disaster.
And then you would have, and then you would have issues with, well, you're supposed to pay X amount of child support, X amount of alimony. What if they shorted the child support? If they paid part of it as some alimony, some child support? It was messy. So the IRS, in my opinion, or the federal government just said, look, let alimony is not a, it's a tax neutral thing. We're not going to tax it. We're not going to give you a deduction. So the third thing though is going to be property transfer between spouses. It's really important in real estate, right? So let's say spouses own a home together. We're going to touch on that in a little bit. Let's say they own rental properties. How, and the part of the divorce decree says, all right, John, let's say Joe and Susie are married. They own a commercial building worth $1 million. They don't have any debt on it. They get divorced, and Susie's going to retain the building, but she owes Joe half of the equity of that building, right? Well, what if they don't have $500,000 of cash? Now we've got to figure out what to do. Susie might have to get a mortgage and pay Joe off of his equity, or they might have, maybe they don't want to sell the building. Maybe their business operates in the building. So it gets really sticky. So the division of property between spouses, especially real estate, but it could be partnership interests, it could be investment assets, is critical. And then the other thing is, what if they bought that building for $100,000? You the and who's going to pay the gain on it, right? I mean, if it's gosh, it gets very, very tricky. So again, we want to hit the considerations. We might have some more content coming in Teaching Tax Flow based on um, diving deeper into some of these. So if you have a family law attorney that you know and you're watching or listening to this, send us a message, put their name in the comments. We might reach out and get some more content from them. But yeah, property transfers between spouses, division of retirement accounts, right? IRAs, 401ks. This gets crazy, and there is some relief for spouses that receive part of a retirement account, where they can take the money out of their retirement account. They have to pay federal tax on it, but they don't have to take that 10% early distribution penalty but it has to be done through a quadro. I know I'm using another acronym, qualified domestic relations order. So the point is this: think about retirement accounts, right? Once the spouses separate, they're going to have different tax rates. So the planning involved here is, okay, does one spouse maybe in the lower tax rate take more of the retirement assets? And can that spouse maybe take some of that money out of those retirement assets at a lower tax rate and without penalty? With the right planning, that could happen.
And you said
Um,
the key word there, planning, right? So I mean, not saying, "Hey, you know what? Your CPA is a marriage counselor." Hopefully, they're not a CPA and a marriage counselor. It might be a little complicated, but I imagine it's always very helpful when somebody reaches out ASAP, right? Talks to their tax professional and says, "Hey, look, we're likely going to be there's going to be a change in our filing status for the upcoming year,"
right,
right? And you can help them with that planning. So it's not just, "Hey, what happened? Oh crap, we should have done something 6 months ago. Would have avoided
right.
this. Now it's too late, etc." Right?
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell them TTF sent you.
And usually it's very common for that year of a divorce that there's going to be more tax extensions filed because I mean, I've been doing this well over 20 years. I've seen almost every circumstance out there with this, because sometimes you don't, I mean, you're hoping that there's some type of amicable arrangement or at least a formal arrangement. And that dovetails into my fifth. is dependency rules and child-related credit. So let's say there are dependents involved. Who's claiming the children as a dependent? Who's taking the child tax credit? Who's paying for the child care? There's just so many things that you can think about, especially with the kids. 529 plans. I mean, there's just tons of stuff. I'm dealing with a case right now, which is number 6, sale of the marital residence, right? What might happen is neither of them might want to retain the marital residence, or maybe they can't afford to and they have to sell it. How is that? How is that divvied up? Is it 50-50? Did one of the spouses own it before the other spouse, um, before they were married, and one moved in? There's so many considerations. So sale of that marital residence, if they own that property, is my 6th. My 7th, the final one, is going to be those basis carryover and passive loss limitations. So John, this is something that's people don't really think about. We had a case in our private CPA practice. We had this was quite a few years ago. We had a client with about $300,000 of passive activity losses, and the client, typically when you have the situation, it's very difficult to work with both spouses after separation, and just because you've got conflicts of interest to deal with. But the client that we retained, unfortunately for him, his spouse and his former spouse's legal counsel weren't very tax savvy. And in the agreement, he got to keep all of the passive activity losses because they're, which were, $300,000 of passive activity losses. That's worth $100,000 of tax down the road when he sells property.
Right, right.
So, and you've got to look at making sure we have capital loss carry forwards that go with the spouses. So again, we don't want to get too deep in the woods here. But my point is this: there are a lot of considerations when you're going through a divorce or separating. Many times, and like you made a good point, many of these things are non-financial, or maybe they, someone isn't. We got a lot on their mind, and there are other factors like where are our kids going to go to school, where are we going to live, there's just a lot of dynamics there. From a tax perspective, there are a lot also. So let me run down these 7 real quick one more time. Let's put a bow on this. And again, if you have any questions, any comments, comment on this YouTube, or if you're listening on your podcast, you know what? Jump into our Defeating Taxes private Facebook group. Just go to defeatingtaxes.com. It's free. You can post anonymously. We know this is a sensitive topic. So what do we need to consider? Filing status, treatment of alimony or child support payments, property transfers between spouses, including stocks and real estate, division of retirement accounts. So that includes IRAs, 401ks, and maybe these quadros, dependency rules and credits related to the kids. If you have a marital residence, selling it. And then finally, basis carryover and passive activity loss limitations. Not the most exciting things to think about, but definitely talk to your tax professional. And these are one of those triggering events where a lot of times someone may have self-prepared their return, that it's time to talk to a tax professional and invest the time and effort into planning as well.
Absolutely, Chris. That's a great place to kind of wrap this up. And I'll say a couple things, not just related to this podcast specifically, but really where teaching tax flow builds on things, right? Like all the content, you and I put out. I mean, a lot of this, right? I'm more of the audience and the average Joe. You're the one, that's bringing the expertise. But looking at all of our content, right? Say we're at this one. Somebody says, "Oh, this is great. I found what I need about, I'm going through this or going to be going through this." But thinking back, right? We've talked about personal boards of directors. Now, what does that mean? Listen to that podcast. That's your attorney. That's your, insurance guy, your tax professional, all these things. Those people might be called off the pine, right? You might call on them at some point in your life like this when all this chaos is happening. So why I say that, right, is our whole goal at TTF is to bring so much stuff together for you. So, and that's just one example of when the earlier you take advantage of something like building your personal board of directors, you're not going to go and build a personal board of directors in the middle of a divorce. Let's be honest, right? But you're going to need those people pretty darn fast, and there's going to be huge value there. So just think about that. And Chris, I'm so happy you mentioned planning in there a bunch of times. Again, you're not a marriage counselor. Hopefully you never become one because you're a damn good tax professional and we don't want you to change. But, find the right people, utilize them, and just don't be afraid to communicate to people. I think even with taxes, right? I know a buddy of mine that I was talking to last week, and then I'll shut up, is he's going through a very unique situation. There's a bankruptcy, there's all this stuff, and he's more afraid to talk to his tax professional about what's going on than actually anything else. It's like, dude, just say it, talk to them about it. It'll set you up. People are more afraid to be judged than they are to find a solution, I think, sometimes. So don't be that person. Don't be afraid. Ask the right questions. And I can almost guarantee you somebody's out there wanting to help you very, very soon. So take advantage of it. Again, Chris, you mentioned that offer about the free hat in there. If nobody's done that yet, do it, because I know we're going to give these 3 away really quick. And then I'm going to have to order more of them eventually. So, all right, everybody, that's it for this one on the Teaching Tax Flow podcast. We'll see you again next week.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciuro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.